Morning, Alpha Team. To have a new week starting 20th of May 2024. And we came through last week quite well, didn't we? We said at the beginning it was possibly going to be the time to change view for a lot of people. It was set up for bulls and bears alike, and it was going to be pivotal what happened with the inflation figures in the States. And I was expecting the bull side to be victorious, and so it proved. And I said already, people had in advance, some of the bears had said they might change their mind. Some were a bit sneaky. They changed, as we showed in the live show on Friday, they changed their tops to current all-time highs as they were on the breakout. And then that was the end of the multi-decade bull run, and it's time to sell off. I mean, it's basically the 15th sell-off in the last 6 months, 15th call of top of the market. It's getting quite embarrassing. And that came out in the same week as the announcement of Happy Gilmore 2, which is a golfing classic. And the only thing that they didn't tell us was whether the eponymous hero would yet again have an underdog tale. They don't have the plot line yet. So I got thinking and thought, what would be quite apt for a golfing movie with the way the markets are set up? How about Tin Cup? That was the one where the hero, faced with winning the US Open and a par five where he had to lay up, that was against his way of playing, and he continued to keep trying to hit the green in two, despite all the evidence telling him to do something else. And that, to me, sort of parallels where the bears are. They just keep trying to call the end of the market and keep plonking it in the water. It's sometimes you've got to be a little bit more realistic, and the people to really trust are the ones that are willing to change their view when the data changes, and that'll come up a couple of times today when we look at some of the charts. And socionomics is quite important, and over time, the people who study that, the study of how the economy and markets sit alongside real life, often you can spot in the media and the films and books that are popular that day what kind of underlying sentiment there is. So that would again be quite apt if you had that kind of movie set up for Tin Cup 2. Something else we showed was the Captain Sensible and Mark Demon. It's down below on the Thursday, Friday update for what happened last week. And Demon in Paris was getting all fidgety and angsty about future black swan type risks that the market aren't looking at. He's getting quite downbeat about it all. And then when he was asked why markets so buoyant, then he said, too much happy talk. So that's when I slipped in the old Captain Sensible special of talking happy talk. To the extent that on Friday morning on Bloomberg's sort of market chatter around 8 o'clock, they were pushing their sort of market analyst, Mark Cudmore, to take it on. And he quite rightly said, Demon is not a great caller of short-term markets. He may have good big picture stuff, but they're almost trying to set up a talking heads boxing match type thing. That'd be quite interesting to watch, actually. But we said on Friday during the live show, the Dow, we presented how that has been a good index to explain the setup since the COVID top and how people have put that together. And it's either the end of moving into the next high at the start of 2022. A lot of the big bears in the technical world had got that as the all-time multi-decade super cycle type high, of which we're supposed to be tracing out a very big either consolidation wave or a complete reversal of a lot of what's gone on. But as I said, you've got to be true to how the setup is, and the ones that have set that up as being breakouts for markets and the start of a new bull run certainly seem to be in the ascendancy with the way it's playing out. And we've probably got a lot more to come. So that is the sort of background setup to that 3-4-5 heaven. We talked about it a lot on the live show. Very happy to take questions on it again. We presented last week about the presidential fourth year seasonality, and that sits nicely with how the markets are set up. But this week, we have got NVIDIA coming out on Wednesday after hours. So a lot does depend on how that goes. So it's very much the data, the PPI, and we talked through that, how it missed by spot 3% month on month, despite then jumping spot 5% on the monthly figures. So that gave you a net spot 2 move, which was exactly in line with what was expected. It's just how we got there. and then CPI was in line to slightly lower, and the underlying components from both of those that hit PCE were all kind of subdued. So despite underlying supercore maybe being slightly worrying, and you can keep stripping stuff out until you find one that fits. For those that are hawkish, it very much looks like the disinflation trend is still sort of intact. It's not restarting inflation pressures, but underneath there is something quite weird going on. And I mentioned this a couple of months ago, and some people said that the perversion in this market is that we might need to cut interest rates to stop inflation. Well, that sounds bonkers, doesn't it? But Rick Ryder, the BlackRock bond guy, reiterated this on Friday on Bloomberg. And how it works is basically we seem to be in a two-tier system, particularly in the US, where you've either lower wage, you may be working two jobs, you're having to borrow money, so you're getting squeezed from both sides, lower wages, higher costs, you've gone through the savings. Excuse me, remember, you must hydrate. Water is the king. So you may be blasting through all the COVID free money, and things look quite hard. And Walmart last week said there's very much evidence of people trading down. That's why they're outperforming. Against that is the kind of higher middle income people, those that they're either baby boomers with lots of savings or high earners. They're the other way. They're not having to borrow so much. They've got excess savings. It's all put into high interest earning instruments, and they are possibly getting anywhere between 7 to 10% of returns, and all that money is being spent, and it's been spent. Where is inflation sticky? It's in the services, kind of on the auto side, health insurance, boosts, all sorts of other discretionary items that are unexpectedly holding up in the data. So the perversion to come is potentially the Fed picking up on this and then saying that they need to cut just to get things back in line, to start people not necessarily spending that excess cash and saving it and reinvesting it again, etc. So that is not completely out there, and that may well be a kicker as to why I wouldn't rule out there being some form of special Atlanta Fed sponsored data link that suddenly says that's what is going on, and they need to tackle it head on. So it's all about the demographics in the States. So in terms of the charts, let's go in and have a look where we are on the driver for most of these things. Was the dollar. We went into last week saying it looks like we're going to have the sell-off and then one more turn before that long-awaited dollar sell-off comes, and we're certainly still within that. We've had what looks like a decent bounce. It's not quite equal legs from the low that we got last week, post the datas. You'd like to see that potentially hit equal legs, but spot 618 is another popular area where the double correction can turn. It has turned. This is all about whether this is a connector now. The maximum I think we'll probably go to is challenging that 105. But we are going into a very data light week. Take NVIDIA out and there's not much going on. So I think it's probably a week where it's safe to buy indices. Definitely want to pick them up into pullbacks. Commodities, the same. Commodities are set up for breakout. We've said that it's all about whether this first set of 5 waves up have finished, or whether and can we get that beautiful buy period, or whether they go to all-time highs and just keep going. We'll have to see. But in terms of the dollar, it's right back to the same levels as over here, which is pre the third bad CPI print in a row that came in April. So we've gone through the angst of that. And as this was happening on the rally, we had talked about it should be a lot higher given everything that was going on. So that despite the seasonality just failing in April, it certainly leaned on it and countered a lot of very positive noises for the dollar and the hawks. So if anything, getting the almost draw was a good result, and it looks like we're possibly going to play out everything that we had here. Data is cracking underneath, and as we'll explain in a few minutes, there's up ahead there could be some very serious sell things going on the dollar side. So we will mention that soon. Indices wise, again, they've put in a lot of breakouts. They look like they're at the top of some three waves, some five waves hitting higher degree three waves. We talked about all that on Friday, the fractal nature of it, but the setup is one of being positive, of putting in the breakout, impulsive waves that are going to have short, shallow pullbacks and then move on again, as opposed to it being the start of this absurd negativity. Underlying, we showed last week, you can present a picture either way. I just think that is all too apocryphal end of the world stuff, and that there's actually good, we've talked about it for months, growth momentum underneath. The rate cuts are just the cherry on top, blah, blah, blah. And once that rate cut environment comes through for the people who are under pressure, as long as the jobs aren't taken away, then the American setup should continue, and that hopefully feeds through to the rest of the world that, again, is on a similar, if not slightly ahead, easing path. And we'll look at that again in a minute. So the Dow we presented on Friday, very close to a top here, because if it goes more than 2.15 for that current move, you'd have breakouts. It's highly likely we've put in that three top. We're working out some kind of consolidation before we go again. Otherwise, this is the classic extending fifth wave. It'll go even higher than we postulate in the first instance. But it is, just looking at it here from the bounce, we've had one and a consolidation. Then it's all about, is this still a third wave, or have we put a fourth in and a fifth and now going to consolidate before we go again? It's highly likely that we do get this push out here. The Dow doesn't even have Nvidia involved, but if the markets catch fire midweek, then that will definitely put upside pressure on the Dow. And as I said, I've seen some people on the bearish side who have conceded that down out looks impulsive. So that's at least one index that they've given up on. And the S&P, that comes down to playing around at the edges. Remember, we've been looking at the percentage of stocks trading above 50-day moving average, which hasn't quite bounced up into the 70, 80s mark up there. It's still languishing here around 60, 65, but sort of building momentum. It's consolidating at the moment, so you wouldn't expect that to progress until this sort of continued 3, 4, 5, 3, 4 consolidation stage here all plays out, and we break out again. That's probably in here where we get the 70s, 80s again. Now, the other side of it is they're saying 200-day moving average is at a height where it doesn't really go a lot higher, but equally it doesn't really lead to massive sell-offs either. I think we've still got room for more stocks to jump up. And if you think back to where we were 2 years ago in 2022, you had the market selling off quite aggressively. We're much higher than that. So the reverse of that is you're gonna have stocks above the 200-day moving average because it's being dragged around. So if you've got any form of positive market, they're going to sit ahead. This is where the 200-day moving average is here. So you'd expect one to feed higher, as this 200-day moving average is only just going to start picking up because it was selling off into this period 2 years ago. So some of those lower prints will come off. This will continue going higher anyway. But I think the underlying stocks are set to carry on trading way above that 200-day moving average. So one feeds the other just by definition. Nasdaq, again, we'd moved into this fifth wave looking even more impulsive than the previous third wave. So that again could lead us to talk about this as being an extension at some point. But at the moment, we'll leave it as just the 3, 4, 5 heaven. We are consolidating here just above all-time highs. Within that, looks like you've got a 1, a pullback, another exertion. So it looks very much like we've got a fourth wave and a fifth to come, just how we set up. We should really touch the top of this trading channel at least before we put in the next degree higher consolidation, before again we see further. This is going to grind to the upside. The underlying earnings season has been brilliant, and we've got the daddy boy to come on Wednesday. FTSE, that's a rinse and repeat scenario. It's done a lot of great work, but it does look like we've had an extending fifth wave here to hopefully finish off what's been an impulsive third, and I'm expecting that to have a shallow pullback and move on ahead. The FTSE's going into prime time, and as we'll see in the data, we've got very important week for the UK around inflation and energy caps. We'll discuss that in a minute. The DAX, that has been putting in a little bit of treading water. Again, it's been consistently high. It's had consistently shallow pullbacks. Looks like it's set up to do an equal legs, which will take us back to around 18,400 before we push on. So it looks like a lot of the indices, they're set for further upside, but they are consolidating. Very happy with that. Some of the bears will start telling you, I told you it's rolling over. We're expecting it to roll over or go sideways from a bullish perspective. So it's very, very different. Rather than smashing down here, we're looking for repeat shallow sell-offs and then further grinds higher. The Nikkei has possibly been the least impulsive of late. As you can tell, it's been going sideways. Very much looks like it's in some form of leading diagonal as a breakout here in its first stage. That is a set of what's normally a 5-3, 5-3, 5, or 5 lots of 3 waves. And at the moment, this is set up more as 3 waves up, 3 waves down, a bigger scale 3 wave. And then here, it's either done a 3 wave to put in the fourth, in which case it's going to put in a new high, or that's the A, B. Well, again, it's complicated here, and I think we're going to grind within this channel. So it's either done a 3 wave here, it's within the first and second stage of that. So it may come up and challenge the upside and drop back down. Either way, it's consolidating from where we are here on the chart. Limited upside and downside. It's possibly got to see both before we break out. So just be aware that one's going to range trade. There's probably more impulsive indices to play short term. It's in the middle of the pattern, but I'm certainly not giving up on that, and I'm expecting it to be quite a solid buy if we do get a break of this lower uptrend channel. Look, we then start waking up, and we're looking to buy it again as the end of a 3 wave, 3 swing pattern, hopefully, before we resume serious upside. So keep an eye on the Nikkei. Volatility-wise, the VIX, we said last week what will happen at 8 days a week. I love you. And what did we get? We got the bounce. That's good old Siri jumping in. It's so frustrating, isn't it, when you get this undercurrent of watches and phones jumping in on the slightest hint of you saying a word they recognise. So yeah, we're saying we had a bounce back from that low last week. Nice trading range. Showed you that the market isn't just crazy exuberant. The more that we consolidate, we're going to see range trading within the VIX. It came actually and closed on Friday at the lowest for the year, just to show you that we're still in buy mode. I don't think we've hit fear yet. We're probably in the early stages of moving into the greed side of that fear to greed index that people talk about. But I think it's healthy that we're having this choppy churning bit. It just shows you that it's realistic. There is rotation, and you can be down here in the sort of low echelons quite regularly and continue to motor up. So it's not a sell signal on its own. So EU and GU, people are asking about those on Friday in the live show. It's all about where that dollar is. So if it's still got to finish off that equal legs consolidation, we may get one more little sell-off in both of those, just churning sideways. But I think the bias is to put in the top of the current impulse from the lows of a week ago when we held on to that 107, 106.5 region. I think that it's probably got to put in a short-term high, but it's part of a whole impulse going higher. Talking heads in the Eurozone have been speaking about the June being nailed on. If you go and look at that section, we'll look at it ourselves later. Even the super hawks were saying June's done, but we're not having July. We don't think it's justified. So I think there's been a bit of horse trading going on at the ECB. The hawks have conceded and said, yes, you can have the June rate hike as long as we don't go again in July and we wait for data. So that's kind of telling you we're not going to get sequential cuts unless something goes wrong in Eurozone data. And I've put an amendment between the preview in front of you and this, and we'll talk about it in Monday's live show as well, is that this is the week where the European negotiated wage data comes through. That's 10 o'clock on Thursday morning, UK time. That isn't in the diary that I've put in, and it probably isn't in a lot of them. It's a data point that doesn't always appear, but you need to know about it. That is what the ECB look at. So that will certainly drive what they're going to do for the next 2 or 3 meetings. And they remember we always said that they would have had 2, and this is the second one of these wage data points before the June meeting. So that's playing out nicely. Not expecting any shocks, but that will confirm the EU rate rise. The fact that this remains bullish is because the US rate cut scenario is coming back into play. So again, we talked about that on Friday's live show. It's all about the relativity of it. What's the consensus? And consensus is probably now at least 3 Eurozone cuts, 2 to 4 for the UK, and pricing back in at least 2 US cuts, with 1 possibly in September. So GU, it's more or less the same chart. Keep an eye on that. And as I said, the data this week is CPI, PPI, RPI, and employment and wage data. The expectation is that is going to be quite dovish. They've openly said they're expecting some big improvements. And in the middle of that is off-gems, energy, driver, whatever you call it, the offset, the thing that drives the electricity price, that is going to fall quite markedly again. So that will feed through eventually into CPI. The combination of those is what should give enough room for the June rate cut. So keep your eye on that data midweek. Oil, we've talked about that. Most commodities are bullish. Oil is the frustrating one that keeps flip-flopping between, is it impulses within a consolidating range? Are we seeing A, B, C waves and 5 waves and C waves when we get bullish, or is it nesting and building up for a breakout? Until we really regain the 80s and drive forward, it's going to be a disappointing one, but I wouldn't necessarily short it. There's more risk of either geopolitics returning and or growth picking up than there is of what at the moment is a very tightly balanced supply side. Despite the OPEC cuts, the US has stepped in. But just be careful. Has been range trading, and we're close to the bottom of the recent range. It's been a frustrating one to play, and it's probably just in the way the commodities are playing. You probably leave oil alone until we get better setups. And what better setup? We mentioned tin cup earlier, but how about the silver cup? If anybody's old school technical analysis, there's a thing called cup and handle, where you get this source, like this, the curved shape of a semicircle, underlying curve, which creates a cup shape, and then there's a handle. And when the range of the handle breaks to the upside, then that is what you tend to get. Then is a breakout the same size as the amplitude from the bottom of the cup to the top. So we'll have a look at that. It's in the preview. It's already looking impulsive. Remember, we said last week if gold's going to move, which it did, then silver, because of the nature of which waves we're in and the fact it's been left behind, will start to have catch-ups, and eventually will take over. So I think the gold was up 2 or 3%, and silver up 12%. Massive catch-up on the ratio. So silver is definitely impulsive. We should be playing it. On Friday, we were talking about a confusion on gold. Was that about to break through 2,400? We're wanted. The problem is wanting things to happen and them to play out are totally different. And that straight away we had a gold breakout, and we haven't quite had the pullback to below 2,400. And we'll talk about the setup in that in a short while. But again, if we believed that gold was going to break out on Friday, silver had a massive spurt again. So really do encourage you to be playing silver and gold. And silver definitely has the look of something that is about to go crazy. So look, if you go all the way back to that coming off the gold standard period, been years in the making, 50 years in the making for a cup. We've had this handle, the handle shapes come off, and then you have a double trend line. I haven't put the bottom one in, but the upper trend line there, that's just been broken this month. So once that happens, you're looking to repeat this amplitude here from the break line. Well, that would take you up to $70. We're still trading at 31, 32. You do the math. Gold could quite easily double, but silver, by the look of it, is primed for it. People are going to be all over and I have seen people talk about parabolic moves. The supply for silver is running out, literally, and from the mining side, the discovery side, and obviously super tight supply of what exists. And more is being used industrially and militarily. Those things are primed for big inflows. Really, silver should stay and move in this higher trading range for quite some time this year. So gold, we talked about it, looks impulsive. Next time I'm on a live show, and I've just presented lots and lots about higher highs, creating new breakouts. When we flip back at the end of the show and see gold has just started to break out to a new high, someone virtually come on and slap me on the face and go, look, that's a higher high. It means we're going higher. Obviously, we said we wanted it. We're hoping to get the cleaner pullback within the wave we're in. But as it was, it had a breakout, got halted at 24.20. And then if we look, this is what we were hoping to get in there for ultimate breakout. We are in the fifth wave completely and utterly now. This looks like we're in the fifth wave. So we're in the phase of going to 25.50. We're still at the low 24s, so keep that in mind. But we have jumped a lot. This is all about, from the lows, this wave 4 that we put in, and we're now in the wave 5. So it's minute wave 4 here to get to the minor wave 3 set of 5 waves, the red 5 at the top of the original channel we've been doing for weeks. And we'll look at that again on the live show. The setup here, we've had a 1, 2, possibly a 3 and a 4. And then are we in extending 5? Again, remember, this is, as a third, bigger than the 1. So it is a valid structure that the fifth wave would be longer. It's all about whether within this, have we had a 1, 2, a 3, a 4, and is that topping out at 5, or have we gone back to how we were when we originally broke out into this? Remember the nesting videos we did? We've had a 1, 2. This could easily be a lower degree 1, 2, and we're now in an extending third wave still, where now that we're just beginning to see impulsing moves again and not getting the pullback that we're expecting from this, what looks like a 5 wave. That is more or less telling you we're in some kind of extending scenario. So we're still looking for pullbacks. As we saw on the way up from 2000, they were always shallow on the fourth wave. So this thing's just not letting us in. I always said we've got to be careful when it goes impulsive. You don't get a chance to come back in. So let's look for this week how gold trades. I'm really hoping for a pullback and a breakout. I actually had a play on Friday night. I thought either the Dow would go to above 40,000 or NASDAQ would break up, or they'd have a go at taking out the high in gold. Just with the way the week was set up and volumes had gone quite light. We'd had that impulse in the afternoon. I had a small buy on gold instead of the Dow, so I didn't win. And knowing my look, it'll be breakout as soon as I close out. But we'll have to see. We'll talk about that on another video. So within that quantity space, copper, obviously all-time highs going nuts. China are stockpiling it like it's going out of fashion. Often people look at that. They have got the industrial strategy over there. There's always the threat of them doing something with Taiwan. Copper is the great build-out material, and there's a lot of research out there talking about how the amount of copper demand between now and 2050 will be the same as the total amount of copper that's ever been mined. So it's a one-way bet. Someone in COMEX in the US is obviously short because you've now got this price differential between the US and the London market. And that's telling you that they just can't find the supply. That's the kind of thing that you will start to see either with the Asian price in gold or maybe between COMEX and LME at some point. In gold and the silver, all these things are going parabolic. There's a very good Odd Lots podcast if you happen to be able to listen to Bloomberg podcasts by Jeff Curry, Goldman Sachs guru. of commodities over the years. He says that copper is an opportunity of a lifetime. Very good setup there. Then outside that, cocoa last week was being pushed heavily. Right, got cocoa, yeah, attracting headlines both ways. I put out a meme on the rain's coming back. Here comes the rain again, which for Kenya and Ivory Coast was a godsend because they're almost going too dry. Then you've got people saying the rain's going to be too heavy and it's all going to get washed away. So, and then you've got people with apocryphal tales like Pierre Andurand of Andurand Capital Management. He did open up and say that he'd bought cocoa in March and it had a big spurt up, as you can see on the futures from March down here up to 12,000. It's given up a lot of that, so not surprisingly, he's out there pushing it. He's talking about chocolate. Start hoarding chocolate because there's a good chance, for various reasons, that cocoa supply is going to blow up in the future. It's very inelastic pricing on chocolate. People don't seem to worry because the demand for chocolate's so high, so they keep paying for cocoa until it's disappeared or they can't afford it. Now, remember, if he's also been similarly positioned in copper for the reasons we've mentioned, so an interesting guy to keep an eye on. But that's the kind of thing that's out there in the real world, looking at the fundamentals on the commodity side. They're all there for continued breakout and all really there on demand and particularly on supply concerns. So have all that knowledge at the back of your mind when you're doing your setups. Once you start getting all bearish on commodities, just make sure that there isn't something out there that can suddenly make this thing go into a squeeze. And if you're going to start playing futures when we launch those, then this is really important stuff for knowing exactly why certain contracts are moving and others aren't. So Japan, we've mentioned what they've been doing with their yen interventions. People have looked through the data. It looks like they've spent $62 billion so far. I've said that if they just put the rates up 1%, that would be a new bill of $100 billion per year. Just how much in total do they want to spend versus actually doing the one thing that would really get the yen going? Now, Janet Yellen, I said last week, has been asking for them to talk to her before they do any other kind of intervention. And the main reason for that is what is rumored next is that rather than buying the currency, and they've done that quite well and done it on days when the US has fallen. So they may have done some this week when that data was favourable for the US rate cuts coming back. But what they're going to do next is follow the China lead and start selling their exposure to US Treasuries. So that's big problems for the US because a lot of the natural buyers have disappeared. They're now reliant upon the speculating sector and obviously having to buy them themselves. The Treasury have got a massive record raft of issuance to come. So the last thing you need is a large seller in amongst that. That will just feed back into selling of treasuries, selling the currency. They need to print more money to buy the bonds if they have to do that. So that weakens the currency. You've got a buyer of yen. That goes the other way. So you get a double whammy of dollar short, yen positivity, and the debasement of the dollar again, which will hit the commodities for more further breakout. That whole thing becomes self-fulfilling. So the last thing Yellen needs is that kind of conundrum. And obviously the commodity market is probably primed for that to happen. So make sure you're totally aware of what's going on there. You hear about US Treasuries being sold by Japan, you get on the yen and you get on the commodities super quick. And I mentioned it on the live show. The big options volume originally was 155. Since then, there's been 160s and 152s. I don't know whether that's people worrying about the yen strengthening quickly, but apparently there are a lot of natural trade buyers and retail buyers at the 152 level, which is now support, having previously been resistance. We talked about how that has classically flip-flopped. It could be a risk reversal even with people looking for new upside above 160. Just keep in mind that is definitely a trading range that looks like it has got a floor to it until they do something super positive. And it will be another busy week for talking heads. I've listed as many as I could find down below. As ever, each week I do that and I review and keep a record of what they've said. So I think you need to keep on top of that to know where people are. But equally, you've now seen how our rule changes have come in terms of the qualified traders, 4 minutes around all the data points, and that includes speeches, but speeches aren't instantaneous. They go on. Some of them go on for an hour. A bit like me. So keep that in mind. You can't buy 2 minutes before the speech, and you can't sell or you can't trade until 2 minutes after the speech. So you need to be on top of when those speeches that affect whatever instrument you're playing in are starting and finishing. If you're on challenge phase, it doesn't really matter, but it's a good habit to get into. A side note, India is having the 5th of 7 parts of their election process. It started in April, finishes at the beginning of June, and we'll get the result on June the 4th. So there'll be chatter about the 5th phase during the week. So data-wise, Monday, Bank of China rate decisions, PPI for Germany. So that'll be interesting to see whether they are seeing any feed through. They're bouncing off the bottom activity-wise. Right move for UK house price index. Royal Bank of Australia meeting minutes. They'll talk about the data points still being difficult, although there was some slightly supporting stuff over the last couple of weeks. Eurozone construction and trade balance. Again, it's a leading indicator on the construction side. See whether the manufacturing is starting to catch a bounce, industrial production. Canadian CPI, keep an eye on that. API crude data, we're all beginning to watch that, aren't we? And that has been the leader. That came into line with EIA with a drawdown last week. See whether that continues. Japan, they have this thing called the Tankan survey. That's all about activity. We'll see their machine orders and trade balance. Are there any effects coming through from the weak currency? New Zealand rates decision not expected to move. The big daddy boy for UK, which is all the PPI, RPI, CPI, and some employment and wage stuff. Public sector net borrowing requirements. That's how much the Treasury has to borrow. And then the US, it's all about home sales and construction and permits this week, starting with existing home sales on Wednesday, EIA crude. Look out on Wednesday night for the FOMC minutes. Again, for data points, you probably have to wait until that's all been discussed. Thursday, New Zealand retail sales, Aussie PMI, Japanese PMI, and then the Eurozone, France and Germany PMI. So big for the activity week. That's a big one on Thursday. Eurozone overall consumer confidence. And then the thing I mentioned earlier, Euro wage data, negotiated settlement, 10 o'clock. Shouldn't be funny, but it should be a confirmation that you're going to get that June rate cut in Europe. UK PMIs as well. Then again, US, they've got a PMI, building permits, and the composite S&P PMIs, that is manufacturing and services put together. New home sales, and then we saw Philly Fed last week. This week it's Chicago Fed and Kansas City. See if there's any read-throughs. They're sort of lower value reads. Friday, New Zealand trade data, Japanese and Tokyo CPI. Obviously absolutely desperate for that to show some kind of flicker. Not sure that it does. The preliminary update wasn't good. UK retail sales, we really want to see something just bang in line really there. We don't want that doing anything to disturb the idea we're going to get a rate cut. The classic US dollar durable goods, Michael Jordan, jobby that we all know about. Canadian retail sales, and then we're back the bi-weekly Michigan expectations and sentiment. So we'd like to think that they all reverse a little bit after last week's surprise. We have seen inflation expectations drop. We've had dovish data. Will that improve the mood amongst the consumers? So it's all there. There'll be a panel speech overnight on Sunday night. We'll have a look at that on Monday. Write that down to look at. Jim Broadbent for the Bank of England is speaking. Buba has a monthly report. Bostic, Barr, Waller and Jefferson all chatting during the afternoon. Again, big day on Tuesday. Got the RBA meeting minutes, as we mentioned. Yellen is chatting for the Treasury, so there might be something interesting from that. Lagarde's chatting at the same time. then we've got a whole host of people. In fact, and at the end of the day, Bailey's chatting. So Tuesday's a big one for speeches. Keep an eye on them and be aware when they're taking place. Wednesday, Collins, Bostic, Mester, New Zealand rates, we said. Breeden, again, for the Bank of England. Pill on Thursday, he'll have had some inflation data to look at, keep an eye out for what he's talking about. Jourdan for the Swiss bank on Friday. Morderer and Nagel around, possibly to discuss that wage data that will have come out on Thursday. Waller, the last one for Friday. But as ever, there'll be others appearing on Bloomberg, etc., etc. Right at the end of earnings season now. Palo Alto Networks is probably the biggest apart from NVIDIA. Got some high street names, Lowe's and Kingsfisher, NVIDIA, Analog Devices as well, Synopsys, Target, Marks and Spencer, that'll be interesting in the UK for spending trends. But pretty quiet week overall. We're right towards the very end. It's all about NVIDIA on Wednesday night after hours. So as ever, go through what happened last week. There's some very interesting comments from Europe, and even some of after the CPI data, and some of the American guys started just opening the door slightly, so you can just get a feel for what people are looking at. And it's good to see that Barkin was looking at the slowdown of spending, and Bostic is looking at the rent trends coming down. So they're all looking at the right areas, even if they are the hawks. So very encouraging setup. So good luck with your trades. As ever, try and join me for today's live show on Monday, and we can discuss anything that's in the preview or any concerns. Trade safely, and we'll speak soon.